Hi, my name is Brad Neuman. I'm with Alger. As Justin mentioned, we have been in business since 1964, one of the pioneers in growth equity investing. That's all we do. We're very focused on that. We've been kind of on the leading edge of innovation and change for the past 50 years plus, and think we'll be leading that charge over the next several decades. And what I want to talk to you about today was kind of some observations that we have about what's happening in the capital markets, which, we live in very interesting times. There's this dramatic thirst for yield that's being felt so acutely around the world, causing us to do some silly things, like any very intense thirst. It kind of manifests itself in some very odd behaviors. So, for instance, there's $15 trillion of debt right now that is negative yielding. So people are actually paying to lend, which is a peculiar state of affairs, not getting anything in return. And these investments are very likely going to lead to negative real returns, in fact, negative nominal returns in many cases, over the long term. In fact, one of the silly things that we've done is invest in these very long-term duration bonds. So as investors, those of us, not Alger, but others have looked at these 100-year bonds from governments, such as Argentina. Now, I don't know why anyone thought it was a great idea to invest in an Argentine bond that matured in 100 years when they've defaulted 8 times in the past 2 centuries and twice in the past decade. But some people thought that it would produce decent returns, even though the yield was less than 8%, which is less than what equities have returned over the past several decades annually. And lo and behold, that did turn out to be somewhat of a silly thing to do, because Argentina was able to sell a 100-year bond pretty recently. Now, Argentina is an interesting country. They've defaulted on their debt no less than 8 times in the past 2 centuries and 2 times in the past 2 decades. So who was it that thought it was a good idea to invest in 100-year Argentine debt at under 8%, which is less than what equities have returned over time? Needless to say, that probably wasn't a good idea. Today, those Argentine bonds are trading at about 40 cents on the dollar. And I haven't said this publicly, but I'll say it in this room. The other country that begins with an A, Austria, that's issued 100-year bonds that are currently trading at about 1%, I think we'll look back on that and possibly think that that was quite foolish as well. So, there's this thirst for yield that we all have that's being kind of encouraged by central banks as interest rates fall. And people are throwing money at it. So you can see on the chart on the left, over the past 3 years, bond funds have attracted nearly $1 trillion, a multiple of what equity funds have attracted. In fact, year to date, bond funds have attracted several $100 billion, whereas the money flows into equities have been negative. So people are putting money into bonds at what will surely be negative real returns over the long term, and in many cases, negative nominal returns over the long term, and they're taking cash away from equities. They're also selling risk assets and putting money into cash. You can see on the chart on the right that the balances of money market funds, the cash that we all hold in our brokerage accounts, is at near record highs not seen since the global financial crisis. So the question is this a smart idea? Is it a good idea to chase yield at very low rates that are likely to produce negative or certainly negative real rates? Or should we be looking more at equities, despite the fact that it's a very uncertain environment, economically, politically, what have you? Well, let's think about the question and maybe use some data to try to answer it. So historically, as you can see on the chart on the left, the 10-year Treasury bond yield is far in excess of the stock market or the S&P 500 dividend yield. In fact, over the past half century, it hasn't been close. But recently and today, S&P 500 dividend yields, stock yields, are in excess of bond yields. We're at about 1.8, 1.9% in terms of dividend yield, and as I mentioned, the 10-year Treasury bond is at about 1.5. So there's a positive spread for owning equities, in fact, and of course equities are taxed, dividends are taxed advantageously to coupon on Treasury bonds. So you're getting a better yield in equities. But then you say, well, but of course equities are risky, and I don't know if that's a good idea, and maybe that's too much risk for me. So I put up the chart on the right, which I knew would look good. I didn't know it would look this good. And what it is it shows how much dividends have changed over the past half century. What you're looking at is the 10-year rolling growth rate. So how much it's grown every 10 years on a monthly basis over the past half century. And what do you see? You see the dividends have never declined in the past half century. And in fact, the average dividend growth is about 6% over the past half century. So when we think about equities yielding more than bonds, they're yielding more than bonds despite the fact that equity dividends have very reliably grown over time, whereas obviously the Treasury bond coupon does not grow. So, how risky is it really? It looks like equities will put more cash in your pocket than bonds, and I think some people might be surprised about that, but that's the state of the world we're living in right now. Another way to look at yield is not just to look at the dividend yield, because that's only one small part of what companies do with their cash. Yes, they send you a dividend check if they're a dividend-paying company once a quarter, and that's nice. But they also have other free cash flow, and they do other things with that cash flow. They might invest in their own business. They might make acquisitions. And in many cases, they repurchase stock. And repurchasing stock is very similar to a dividend yield. Now, yes, you don't get the check when they repurchase stock, but your ownership in the company grows. All else equal, the stock price appreciates because they are retiring shares outstanding. If you don't sell your shares, your ownership in the company is growing. So it's very similar to a dividend yield. In fact, I would classify them as both returns of capital, both stock repurchases and dividend. And the chart on the left shows you what happens when we add the repurchase yield, which is about 3.5%, 3.6%, to the dividend yield, which, as I mentioned, is about nearly 1.9%. Together, you get about a 5.5% annual return of capital in equities. And you say, well, that sounds pretty good relative to what I'm getting in my checking account and Treasury bonds. How does it compare over time, though? Maybe that's what investors always required, a large return of capital relative to prevailing interest rates. So we have the chart on the right that shows this total yield. Again, it's share repurchases plus the dividend yield. What that yield was relative to corporate bonds. Because corporate bonds obviously have some risk, maybe equivalent to stocks. And you can see that corporate bonds historically have yielded much more than the total yield on equities. When the chart on the right is negative, it means that equities yielded less on this measure than bonds. But lo and behold, today we have a very different situation where the total yield on equities is more than what you're getting in corporate bonds. So whether you look at on an absolute basis or relative to history, the amount that you're getting back in terms of return of capital or yield in equities looks pretty good to us relative to these very low rates in bonds. And the longer the bond yields stay here, the better the chances probably that investors start to get pushed out on the risk curve and say, I can't live on these bond yields, the equity yields are pretty attractive, and you might see valuations rise there. So if we put it all together, I mentioned that equities, they do a lot more than pay dividends. Companies do a lot more than pay dividends and repurchase shares. They have free cash flow. Some of it goes to invest in their business or make acquisitions. We can call that earnings. And so historically, when you look at the S&P 500 price to earnings multiple, so the price of the stock in the aggregate, the whole stock market, divided by the earnings of the whole stock market, that's the dark blue line, that's been, give or take, about equal to Treasury bond PE. What do I mean by Treasury bond PE? If you have a Treasury bond yield of 5%, that we're just taking the inverse of that, so it would be about 20 times equivalent price to earnings multiple. So anyway, those two measures have been about even over time up until the global financial crisis, where you see bonds got very expensive relative to stocks. And so when we put the whole picture together of how much earnings there's available to investors like you all, you see that bonds are very expensive relative to stocks, particularly with regard to history. And then you say, again, well, but equities are risky, and I don't know if I want to take that risk. And that's certainly true. Over history, what the market has decided was the growth potential of equities has been about enough to offset the risk of equities, because obviously Treasury bonds have no risk. And that's why the dark blue and the light blue lines were on top of each other for many decades. When we think about what is the real risk of equity earnings, I did the same thing that I did with dividends on a couple pages ago, and we looked at what the earnings growth rate has been over 10-year rolling periods. And certainly there have been some scary times. After the global financial crisis, we nearly got down to 0% growth, annual growth on a 10-year basis. In the early 1990s, after the savings and loan crisis and the recession then. So certainly it's volatile, and maybe that provides some risk, but the fact is that earnings over a 10-year period generally grow. In fact, they haven't gone negative over the past half century. So I would submit to you, if you're a long-term investor, equities may not be quite as risky as you perceive them to be, and their yield may not be as minuscule as you perceive them to be relative to bonds. Another way of looking at all this is something called the equity risk premium, which may be a new concept for a lot of you. It just measures how much investors need, how much the required rate of return is over and above Treasury bonds. So if I told you all that I was going to give you $110 a year from now, you probably wouldn't pay $110 for that. You'd pay something less than $110 because you have some kind of required rate of return. You would like to get paid for the ability to lend out your capital or invest your capital, right? If your required rate of return was 10%, you'd pay $100 for that $110 in a year. And so my point is, if we look at what that required rate of return has been over and above government bond yields over time, stocks are actually around the world about as cheap as they've been in many decades. And again, that's because interest rates are so low around the world. And if I put all this together and I think about, we want to think about, well, what should stocks and what should bonds return over the next decade? So unfortunately, I don't have a great crystal ball to tell you what the stock market is going to do in the next 6 months or the next year. Hopefully, you didn't come here for that. If you did, there's still some food left up top. But I do have a really good framework to help predict what stocks and what bonds will do over the next decade. I'm pretty confident in it because I have this really good relationship. If you look at the chart on the left, what I did was, over the past 3 decades plus, since the mid-1980s, each dot represents a month in time. And that month in time has 2 coordinates. It has on the x-axis, it has the PE during that month, and it has what the 10-year annualized return you would have gotten had you invested during that month. So for instance, say you had invested in the tech bubble, which was probably a lot of these 20 and 25 times earnings, relatively expensive for the US stock market. You would have received on average about a 0%, maybe a little negative or a little positive, but around 0% annualized return over the next 10 years. Pretty terrible, right? Had you been smart enough to invest at 10 or 15 times earnings, maybe a lot of that is in the mid-'80s or early '90s, you would have received a double-digit annualized return over the next decade from those time periods. Pretty great. The beautiful thing about this chart is that there's a very close relationship between the PE you invest at, price to earnings multiple you invest at, and the return you get. It makes it very simple. We could watch CNBC all day. We could read the Wall Street Journal. I'm guilty of being on some of these programs. And you can make it as complicated as you want. You could talk about politics. You could talk about economic indicators, anything you want. But the fact of the matter remains that over a 10-year period, there's a very close relationship between the starting valuation of the stock market and the returns that you all receive. In fact, the relationship is so good that the R squared is 0.84. What the heck does that mean? It means that 84% of the variation in the returns that you've received over 10-year periods over the past several decades has been solely attributable to the starting price to earnings multiple, the starting valuation. So we have this really good framework to figure out what equities are going to return over the next decade. In fact, if you put the current price earnings multiple, which is somewhere between 16 and 17 times earnings, and you drew a red line up to this relationship called a regression line, and then over, you'd see that equities would return about 7% annually over the next decade if you believe the regression or historical relationship. Now that 7% is lower than what we've received over the past, say, century. That's been closer to double digits, even 11% if you go back a full 100 years. So it's going to be, in our view, sub-normal or sub-historical types of normal returns in equities. But we think they're pretty darn good relative to Treasury bond yields, which imply that the overall bond market will only give you a 2 to 3% kind of return. And we think real estate's kind of a little north of that, but in that same low single digit to maybe mid single digit ballpark. So putting it all together, you have these very low interest rates that we think make equities actually pretty attractive from a yield or valuation perspective, and certainly from a potential projected return perspective. So, just talked a lot about people investing in bonds for yield and this acute thirst for yield. I think another reason people are investing in fixed income is because people are looking for certainty and safety and security in what is a very uncertain world. I have a chart, I didn't bring it with me, but there's a few academic researchers who chart policy uncertainty over time for many decades. And today it's the highest it's been in history, according to their analysis. So certainly we live in very uncertain times. So what can you count on, if times are changing? And I'm going to present you with some evidence, and I'm going to ask you to draw on your own experience that the one thing that you can count on, no matter who's in office in the White House, who's controlling Congress, what's happening with the economy, et cetera, and the media, the one thing you can count on is innovation. And innovation is the most powerful force in the economy. It triumphs over the volatility in economic cycles, which we'll talk about, and it provides the most fertile ground for investment opportunities. So to prove to you, which again I think you already from your years on this earth understand how important and powerful innovation is to the economy, but to give you a little evidence that you may never have actually seen in print, I'm going to take the example of illumination. Now obviously artificial illumination or light is extremely important. I couldn't talk in this room without the blindingly bright light bulbs that are in my face. We'd all have to go to sleep at sunset, etc. So light's obviously very important. And what this chart measures is 200 years of light, how many hours of light you could purchase from the same 1 hour of work over the 2 centuries. So the 1 hour of work doesn't change, but as you'll see, the amount of light that you can purchase with that hour of work changes dramatically. So in 1800, the technology for generating light was a candle, a tallow candle made of animal fat. And using 1 hour of the income from 1 hour of work, you could purchase about 10 minutes of light with this tallow candle. And then later in the 19th century, if you think about Little House on the Prairie type era, the kerosene lamp came on the scene. And 1 hour of work using the kerosene lamp technology could get you a little shy of 10 hours of light. So you made a huge jump with that technology from 10 minutes to a little under 10 hours. Then the modern light bulb was around in the mid-20th century, around 1950, the incandescent bulb. And 1 hour of work using that technology could buy you about 500 hours of light. So we stopped really thinking about, you don't work for light anymore when you're getting 1 hour of work is providing hundreds of hours of light, right? Today, if you're like me, you're replacing around, you're replacing around your house these traditional incandescent bulbs with these LED bulbs. And notwithstanding that they're a little expensive to purchase, they last for a very long time. In fact, 1 hour of work using these LED bulb technology can provide 13,000 hours of light. So we've gone the same hour of work, the income from 1 hour of work, from being able to purchase 10 minutes of light with the candle technology to 13,000 hours of light with the LED technology. That's over a 70,000-fold increase. That's 5% annual productivity measured in light. And I think that's why we live better than our grandparents lived, because this innovation has dramatically changed our productivity. Today, no one gives a second thought about how to pay for light. Now, one very interesting thing here is if you look at this y-axis, it's kind of funny. It doesn't go 1, 2, 3, 4, 5. It goes 1, 10, 100, 1,000, etc. It's an exponential axis or logarithmic. And what that means is the change is accelerating over time. It's probably my favorite message that I'm going to give you is that change is accelerating. In fact, I think we're all familiar with the fact that change is accelerating, not just through our own, like I said, years on this earth, but through something called Moore's Law. You know, Moore's Law said that the number of transistors that you can cram onto an integrated circuit doubles every 24 months. So that doubling is actually accelerating innovation. And this chart shows computers over time, or microprocessors, and basically how much processing power you could get from them for $100. And you could see it's exponential, again, on the y-axis. And you probably remember some of these computers, the Apple II, the Atari, the Commodore 64, and some of the newer chips are up here as well. So many of you are familiar with Moore's Law. Why would I bring up something that everyone's familiar with? Because I don't think many people are familiar with the fact that Moore came on the scene about 1965. That's when his paper was written, famous paper was written, where he thought transistors would double every couple of years. This curve has been in effect since well before Moore came on the scene, when we didn't even use transistors, when we used punch cards. There's been that same accelerating rate of technological advancement. In fact, MIT researchers have found that this same exponential technological growth occurs not only in computer processing, but in computer storage like hard drives, transmission like fiber optic cables, wireless technology, energy, and as we saw in light. So, you know, why am I so obsessed with accelerating innovation? You know, who really cares? Well, let me tell you a little story. The precursor to chess was invented in Persia in the 13th century. It was called Shah Mat, which literally means dead king. And the story goes that the king was so impressed with this game, again, that was like chess, that he offered the creator of the game, his chief advisor, anything he wanted in the kingdom. And the advisor thought, and he said, you know, I'd like a grain of rice for every square on the board. And the king said, surely that's not what you want. I have jewels and riches and land. You know, pick something better. And the advisor said, no, you know, I think that's what I want, with the stipulation that the grain of rice doubles on each square, 64 squares. So the king said, if that's what you really want, it's a great game, you can have whatever you want. He told his men to bring in the rice. So they bring him the 1 grain of rice on the first day, then 2, then 4, then 8, 16, 32, etc. And the king is chuckling, but you know, it doesn't make too much of a difference to him. All of a sudden, the bags of rice start getting heavier. The king starts to pay attention. And by the first half of the board, it works out to 220,000 pounds of rice. The king's getting quite concerned. The way the math works is that every square is more than the cumulative sum of all the squares that have come before it, such that the next square after the first half of the board is itself more than 220,000 pounds of rice. By the time the board is finished, the amount of rice is greater than the mass of Mount Everest, or 1,000 times the output of India. And so what the king's advisor has done is essentially stolen the kingdom from the king simply by understanding the power of compounding. What does this really mean for us as investors? Well, number one, this is a feel-good message in a time where every time I turn on the news or look at a social media feed, etc., everything is negative. The fact is that technologically speaking, if you buy into what I'm telling you, this accelerating rate of innovation, the future is going to be very good from a technological standpoint. Two, the future is going to be very difficult to understand. No one would have thought that we would have these little computers in our pocket that give us access to all of the world's information, 30 years ago. In fact, McKinsey was famously employed to do a study, I think about 25 years ago, about how many cell phones there would be, around 2010, and they said a million. They were off by factors of, there were many hundreds of millions by then. So it's hard to imagine. In fact, it's so hard to imagine that when I carry out this curve, we find that the computing power that you can get for $100 will be more powerful than the human brain. Again, that's very difficult for all of us in this room to actually comprehend. I'm not exactly sure what it means myself, but it's a very real consequence of this law of accelerating change in technology. So for investors, it means that the change that we see is accelerating, and it may have implications for us in how we invest. In fact, when we look at this chart shows various innovations throughout American history and how long they took to reach 50% penetration of households. How long did it take before about half of the country was using this technology? And you can see that the washing machine and the dishwasher took several decades to reach 50% penetration. But more recent innovations like the internet and social media took 14 and 9 years respectively. So change is accelerating. It's diffusing through society faster, just like those MIT researchers had found. What does that mean for an investor? Well, it means that value stocks, as I mentioned to the gentleman's question earlier, that have a low PE or a high yield because they're out of favor may simply not be cheap, but they may be victims of change, like newspapers, which turned out to be a melting ice cube because the world changed so significantly. Conversely, it may be a tailwind to growth stocks, which have dramatically outperformed over the decade because those growth stocks are purveyors of that change that is accelerating. And this change is creating faster disruption than ever before. This chart shows how many years it took various products over time to reach 1 billion users. And I know you're all familiar with the Microsoft products, right? We all use Microsoft Windows and Microsoft Office. And back when that came out in the 1980s, those products took a quarter century to reach 1 billion users. More recently, Google Photos hit 1 billion users just this past summer. And I'm told that, I think you all might not be familiar with it, but there's a new app called TikTok, which actually originated in China, which is a little like Instagram, but for videos. It's all videos, and kids and young adults, I guess, not me. I'm a little old for that, but post videos. And that's already reached 800 million users in 3 years. So that will certainly be the next piece I put up here. It will probably beat that 4-year mark. So change is accelerating, and it's causing disruption to happen faster than ever before. The turnover, the life of an average company in the S&P 500 has gone down significantly. The amount of time that it's in the S&P 500 over the past several decades because of this change. Okay, so I made my first point regarding innovation and how it's the most powerful force in the economy. It's responsible for real wealth creation. The other thing that I think is really important, my second point, is regarding this certainty and how innovation is something you can count on no matter what's happening in the economy. Now, if you're more interested in what we have to say here about this topic specifically or anything, I invite you to go to alger.com, alger.com, where we've written several papers about this, specifically this concept about innovation triumphing over economic cycles. I looked at the past 200 years, and we found that no matter what's happening in any type of economic environment, and that includes depressions, recessions, panics, what have you, no matter what's happening, there's always areas of innovation and always areas of growth that you can find. So for instance, the chart on the left shows the recession in the early 1990s with this yellow bars, the recession in the US brought about by the savings and loan crisis. And you can see that the dark blue line is real GDP. It grew 4% over this 4 or 5 year period. Now 4% is some growth, but it's very weak for what it should have grown. It should have grown double or triple that, 2 or 3% annually over 4 or 5 years. So it was very weak growth during this time period. Yet there was areas of innovation, like there always are. Back then, there was the PC revolution, where computers were being put onto workers' desks for the first time in history, dramatically increasing productivity. And what happened to PCs? Well, they grew dramatically. They grew over 43% despite a stagnant economy. Similarly, with the global financial crisis, the iPhone was introduced right around here, and smartphone adoption not only grew strongly, it actually accelerated. In fact, my favorite example is the worst recession that any of us have lived through in our lives, the global financial crisis from 2008 to 2011. You can GDP was about flat. U.S. retail sales, which is this greenish yellow line, was about flat over that 3-year period. Again, very bad for what it should have been. Should have been up maybe high single digits. Stock market was flattish, but again, there were always areas of innovation in any kind of economic environment. Here, there was tremendous innovation in retail and media. U.S. internet advertising grew dramatically because of this media shift, and U.S. e-commerce. They both grew in excess of 30%. And so, what we view as our job at Alger is to two things. One, find these areas of growth that are going to happen no matter what's occurring in the economy, which is how we feel confident and sleep at night, and how what I'd encourage you to latch on to rather than what's happening in the financial media and press. And two, we try to pick the winners and the losers from this innovation. So Amazon obviously levered in terms of its business model to e-commerce. The stock went from $74 a share during this kind of flattish stock market to over $200 a share. So that's what we try to do, and what helps us think about the long term and helps us through uncertainty. Okay, and the last point that I wanted to make about innovation is that it's a very fertile ground for investment opportunities. There's a history of creative destruction, which is a term coined by the late great economist Joseph Schumpeter. And a lot of examples here. The telegraph was displaced by the telephone. As cars and tractors grew in the early 20th century, they put many horses and mules out of a job, as well as farmers. And today, e-commerce, which we actually still think is in its infancy, less than 20% of retail is e-commerce, is displacing brick and mortar stores, which we still think there's a glut of. And in the US, we happen to have five times the retail square footage per person than they do in the rest of the world, in Europe and China. So a lot more mall closures, et cetera. But the point is that there's always winners at the expense of losers, and that creates this kind of fertile ground for stock picking and investing. And in fact, again, to the gentleman's question about how do you incorporate valuation to companies that don't have such great valuation? Well, the rules of the game that I gave you for the overall stock market, they work very well for the aggregate of the economy, the aggregate of the stock market. They do not work well when we're talking about winners and losers. So here, what I did was I showed some industries that went through a lot of change over the past decade. And we simply put up their beginning price to earnings multiple, their valuation 10 years ago, and the annual return that they produced over the subsequent 10 years. And what you find is internet retail was very expensive a decade ago, traded at a very lofty 30 times earnings. Again, that compares to the broader stock market at 15 times over time. So very expensive. But the returns were fantastic. They were over 20% annually over a decade. Whereas department stores, their kind of value or losing counterpart were very cheap a decade ago, but they produced very dismal negative annual returns over the following decade. Same thing can be said for internet software and service, which is think about Google, Yahoo, kind of new media, relative to their counterparts of publishing and commercial printing, which were extremely cheap a decade ago, but produced nearly no return. So the point is that valuation becomes less important, fundamentals become more important in these areas of intense innovation. And that's where we think at Alger we add a lot of value. We do intense research on fundamentals and try to pick these winners and losers. In fact, over the past 10 years, the best strategy has been to invest in the most innovative companies. When we rank the overall stock market by the most innovative companies to the least innovative companies, and we do that by looking at how much they're spending on research and development, we find the most innovative companies dramatically outperform the broader stock market by 4% annually, which equates to over 40% over the past decade. And the least innovative companies dramatically underperform by about 4% annually. And so I think that reinforces everything that I've said here tonight, which is that innovation, change is accelerating, technological advancement is accelerating, and companies need to invest to keep up. Those companies that do invest and innovate will do well, and those companies that don't invest and innovate will fall behind. And there's academic research that's come out very recently that you can find on our website or social media feeds that supports this by a professor named Baruch Lev at NYU, who's one of the foremost professors in the country on accounting and innovation. And again, our strategies, this is not meant to be a commercial, but our strategies are more innovative than their growth benchmarks, which are in turn more innovative than the broader US stock market, which are in turn more innovative than the global stock market. So luckily, we live in an economy that's extremely innovative. Not only do we spend more in dollars in research and development than any other country in the world, we spend more as a percentage of GDP, certainly relative to Europe, on research and development. And our strategies, you can see here in the dark blue and the green and the black, are all rate more innovative in terms of research and development as a percent of sales, and they're very innovative benchmarks. So we eat our own cooking, so to speak. I'm gonna wrap up in just a minute. I think that this is kind of hopefully I laid out a framework for you to think about the world and again latch on to something that I think is more or less a certainty over the next decade when very few things are. I call it the framework. I call the lens of innovation, which is very different from traditional investing. Traditional investing, you might look at quantifiable criteria or characteristics. So you might look at the valuation of a particular stock or how fast the stock is growing. If you're looking through the lens of innovation, you don't do that kind of screening. You first look for where is there dramatic change and opportunity, where is there innovation. Traditional investing will have you look at the economic and the market cycle. So if you think that we're going into a recession, you might buy utilities and defensive consumer staple stocks. Or if you think that the growth is going to accelerate, you might be in early cyclicals like retail consumer stocks. Conversely, if you're looking through the lens of innovation, you look at how the industry is going to evolve. Like we mentioned in retail, brick and mortar losing to e-commerce, and you develop that thesis. And finally, with traditional investing, if you're a value investor, you're thinking about reversion to the mean. You're buying a cheap stock that you think is just cheap temporarily that will become less cheap. If you're a growth investor, you're buying a company that's growing quickly that you hope will continue its growth. Whereas if you look through the lens of innovation, you're really looking at what is the impact going to be of this innovation, who will be the winners, and who will be the losers. Borrowing from the work of a lady named Carlota Perez, we believe that technological revolutions come along about every half century. And the first one, we're all familiar with the Industrial Revolution, kind of towards the end of the 19th century, where we had machinery pretty much for the first time, mechanized agriculture. The last technological revolution, I think we're all familiar with, kind of the age of telecommunications, we call it, she calls it, started with that microprocessor innovation around 1970. And what you found was that the invention of the integrated microchip, integrated transistor, was kind of this eruption phase. It led to frenzy in the 1990s of investing and the tech bubble. And that led to a turning point in the actual usage of the technology, which was, she calls the synergy period, where the technology actually gets to be adopted. Obviously, most of us have phones in our pockets that access the internet, and computers are pervasive. There's over 3 billion around the world if we're counting smartphones. To bring me to your question, we believe that we're at the start of the next technological revolution now, and we believe that artificial intelligence is kind of equivalent to that invention of the integrated circuit, the integrated microprocessor. In fact, if we had to pin a point that started the new technological revolution, we'd probably use AlphaGo, which was one of the first artificial intelligence programs developed by Google that will actually learned on its own. So it was given rules to the game of Go, which is a game of skill. It wasn't taught strategies. It wasn't taught how to play. It simply played against itself. And over a period of a couple of weeks was able to beat any computer or expert on the planet. And once you get computers who are able to learn on their own, they're able to exceed and surpass the human teacher, because the human isn't the teacher. And we think that is very powerful. All right, thank you very much.